Imagine you're an investor looking at a massive, global corporation. They make everything from phones and cars to enterprise software. How do you, as an outsider, understand how each of these different parts of the business is performing? How do you know where the company is making its money and where it's facing challenges? This is where IFRS 8, Operating Segments, comes in. Its core principle is simple: to help users of financial statements see a company through the eyes of its management. Unlike previous standards, IFRS 8 adopts a management approach. This means that a company's financial reporting is based on how its internal leadership, specifically, the Chief Operating Decision Maker, CODM, views the business. The CODM is the individual or group responsible for allocating resources and assessing the performance of the company's various components. The standard requires companies to identify these components, called operating segments, and then disclose key information about the segments that are deemed reportable. So, what exactly is an operating segment? It's a part of a company that engages in business activities that generate revenue and expenses. Has its operating results regularly reviewed by the CODM to make decisions about resource allocation and performance. Has discrete financial information available. Essentially, if a part of the business meets these three criteria, it's considered an operating segment. Not all operating segments need to be disclosed individually. A segment becomes reportable if it meets any of the following quantitative thresholds. Its revenue, external and internal, is 10% or more of the combined total revenue of all operating segments. The absolute amount of its profit or loss is 10% or more of the greater of a. The total combined profit of all segments that made a profit, or b. The total combined loss of all segments that incurred a loss. Its assets are 10% or more of the combined assets of all operating segments. Furthermore, a company must ensure that the total external revenue from its reportable segments makes up at least 75% of its total external revenue. If it falls short, additional segments must be disclosed until that 75% threshold is met. Once a segment is identified as reportable, the company must provide key disclosures. These include general information, how the segments were identified, and the types of products and services they offer. Financial information, a measure of the segment's profit or loss, assets, and, if provided to the CODM, its liabilities. Reconciliations, a vital part of the standard. Reconciliations explain the differences between the segment's financial data and the total amounts in the company's main financial statements. This is crucial because internal reporting to the CODM may use different accounting policies than those used for external reporting. Even if a company has only one reportable segment, IFRS 8 requires entity-wide disclosures about products and services, revenues from external customers for each major product or service, geographical areas, revenues from external customers and certain non-current assets based on a company's country of domicile and other key regions. Major customers, if revenues from a single customer account for 10% or more of the company's total revenue, that fact and the total revenue from that customer must be disclosed. In summary, IFRS 8 moves away from a rigid, rule-based approach to a more principles-based one. By focusing on how a company's management operates and reports internally, it provides financial statement users with more relevant and insightful information, helping them better understand the company's business activities, its risks, and its opportunities. Thank you for watching. Like and subscribe for more financial insights.